Michael Gregory is the Deputy Chief Economist and Head of U.S. Economics of BMO Capital Markets. Based in Chicago, Michael provides research support for U.S. and Canadian fixed income business and works with the global fixed income strategy team. Within their economics research department, he manages the team responsible for the firm's forecasts on global interest and exchange rates, along with the North American economy. He works very closely with the Canadian and U.S. fixed income sales and trading desks with responsibility for macro strategic research on central bank policies and credit research on the government sector. Michael is a graduate of the Concordia University in Montreal and the University of Western Ontario in London. Michael also did doctoral studies at Fordham University in New York City. He holds a Chartered Financial Analyst designation. We're very excited to have Michael with us. He's a sought-after speaker, prominent person in the banking community, and we're so pleased, Michael, that you're with us today. So we're going to turn over the presentation to you, and welcome.
Yeah, well, firstly, welcome everybody to the webinar, and it's nice to be here. Just to give you a sense, I do work in a trading room, so there may be a bit of a noise in the background, which hopefully is not too disturbing for anybody. But the good news for you is that if you do hear a sudden rise in noise in the background, it probably means something's going on, in which case you guys will be the first to know. So for the next 15 to 20 minutes, I'm going to give a brief overview of what our thinking is on the economy going forward. And as you can tell from the title of my talk, 3-2-1 Liftoff, the fact the Fed's going to be possibly or probably raising interest rates in less than 2 weeks will be a key theme of that. Now, if there's any doubt about Janet Yellen and company leaning towards raising rates, doubt, I think, was addressed with her speech yesterday to the Economic Club of Washington, D.C., where she basically said, short of something disastrous happening on the domestic economic front, the global economic front, or in financial markets, the Fed is definitely leaning towards raising rates. And that would end an almost exact 7-year period of near zero policy rates, and literally will be the first rate hike we've seen in 9.5 years. And it's interesting that Yellen ended her speech yesterday saying that raising rates, liftoff, that first move, in fact, would be a testament, her own words, a testament how far the economy's come in recovering from the effects of the financial crisis and the Great Recession, and that she expects a lot of people will welcome that. So, in fact, that vote of confidence in the U.S. economy. But is it a done deal? I think that is the big mystery, and it's not. A lot can happen in 12 to 14 days, or 12 days rather, or I guess 13 days now. As we saw during the summer, when the Fed signaled that in July that it looks like September was in play. Between July and September, a lot happened. We had the problems in China, the problems in global financial markets, a huge decline in equity prices, a huge spike and run-up in credit spreads, not only for investment grade but emerging markets as well. And you had a run-up in the U.S. dollar. All of these things tightened up financial conditions and made the Fed very cautious. So that's why the market's not pricing in 100%. It's because a lot can happen over the next week or two. It's interesting though, when you take a look of what has happened since then, things have stabilized. In the October FOMC meeting, the Fed kind of reduced their concern about what was happening in global financial markets. But it is interesting that the U.S. dollar has continued to appreciate alongside the continued weakness in commodity prices. And if anything, it's this combination of a stronger U.S. dollar and weaker commodity prices that have formed a headwind in the U.S. economy, one that the Fed has been paying particularly attention to, and one that I suspect, if it continues to exert pressure on the economy, won't affect liftoff, but definitely will affect the trajectory or the profile for policy rates going up. Moving over 2016. Now, just to take a look at where the economy is right now, there literally is this dichotomy unfolding in the economy, reflecting the headwind created by the combination of weaker commodity prices and, most importantly, a stronger U.S. dollar. We see that just this week when the ISM manufacturing index dipped below the 50 level for the first time since late 2012, indicating that most factories across the country are feeling sort of contractionary headwinds. It's important, though, that despite the fact that the non-manufacturing index also dipped this morning, that it is averaging levels over the past 4 or 5 months that we really haven't seen in a decade. And that gives you a sense that the much larger non-manufacturing part of the economy is actually performing quite well, led by the consumer sector, led by the construction sector, and that is providing the necessary antidote to that headwind we're getting specifically in the manufacturing sector. You even see that if you look at the Fed's own industrial production numbers, where you have a contraction in the energy production, yet in the non-energy segment of the economy, you continue to get advances. And so the question I often get, well, is with this below 50 reading in ISM, is the U.S. manufacturing sector in a recession? Well, it's not really in a recession because, as you know, the ISM is an incident indicator. It measures the number of firms reporting either increasing or decreasing activity across various measures. And but every firm gets treated as one, whether you are the local widget maker or you are GM. You count as one, and that's just the point now, because all the firms that are in the production of consumer goods, they too are running at the fastest pace in more than a decade, leading to continued expansion in the manufacturing sector, despite the headwinds coming from the currency and coming from commodity prices. Now, it's very important in the economy now that the other headwinds that have been working really since the beginning of the recovery have all, for the most part, dissipated. Now, we've had a lot of one-off special factors affecting the economy, mostly weather, sometimes some tax and policy changes. More recently, we had the labor disruption at the West Coast ports, but all of those have dissipated. But more significantly is since the beginning of the recovery, there have been 3 very powerful headwinds that have literally forced economic growth down to the low 2% range, when normally coming out of economic expansion, we see something much stronger than that, even closer to 3%. The 3 headwinds, the first one is household sector deleveraging. During the depths of the Great Recession in the early part of the recovery, households wiped off $1.5 trillion of debt off their balance sheets. Now they are taking out credit again. It's not a huge tailwind for the economy yet, but we're slowly beginning to see the purchases of big-ticket items like automobiles, like household furnishing and appliances, like homes, beginning to drive economic activity. That's a positive sign. Another headwind has been fiscal consolidation. Over the past little while, we've seen contraction, reduced spending coming out of the state and local government sector. The federal government, through its sequestered spending cuts, has been cutting back. But I've never met a state official, when hearing those extra coins jingling around in state coffers, didn't want to cut taxes, didn't want to increase spending, and that's exactly what's happening now. And with the new budget deal out of Washington, which basically eliminates the scheduled further increases in spending cuts, that we do actually have a situation where the government sector is actually providing a little bit of lift to economic growth. The last headwind that has been running since the beginning of the recovery, whether it has to do with the continued problems in Europe in terms of the debt crisis there, the tsunami and the aftermath in Japan. I mean, these things have been running for some time, is uncertainty. Uncertainty about the global economy, uncertainty about the domestic economy. But it's important that a lot of that uncertainty has been alleviated by proper policy responses. We saw even today that the European Central Bank cut interest rates further, actually putting them deeper in the negative territory, and say that they're going to be purchasing securities, QE, printing money basically for a lot longer than they anticipated. So despite the worries about growth, you're seeing the appropriate policy response. The other uncertainty, though, are those intangibles. And for example, the awful events that transpired in Paris and the increase in terrorism, or the concern about terrorism, is clearly one of those sources of uncertainty and continue to weigh on the economy. But the important thing, a lot of those other headwinds have since dissipated. And as these headwinds shift, in other words, what was working on the economy for the past few years shifts to, perhaps only, the exchange rate and commodity prices, you're beginning to see that growth drivers change as well. This chart looks at, the contribution to economic growth average over the past 4 quarters, and you see certain themes emerging. Consumer spending beginning to ramp up. Folks, that is near 70% of the economy. If consumers are spending money, the economy is going to grow. Government spending, which was below the zero line, has moved back, slightly above zero. Continuing to get decent, contribution to growth coming from business, fixed investment, and also housing. The only headwind, as you can see, as that blue line, net exports, has been drifting down below the zero line, meaning it's a headwind to growth. And then, quite frankly, the net export sector is going to remain a headwind to growth as 2016 unfolds. But the good news is the consumer spending side. And we're seeing a lot of momentum build up in consumer spending, in part because of job growth. Now, there's only job growth, is one aspect of income growth. The other one, of course, is wages. And as we all know, up until very recently, wage growth has not been very robust. But more important than that is the fact that in lieu of wage growth, we've had real disposable income really begin to grow quite strongly at a 4% plus pace, which is exceptionally strong, as that job growth and the income generate that has been magnified by what I call sort of boosters or stretchers of paychecks. In other words, lower gasoline prices, lower import prices, lower borrowing costs have all combined to allow the purchasing power of those paychecks to expand. And now consumers are taking out credit again, and they're working a little bit longer on a workly sort of hours worked per week. And because of that, you're getting that income growth that is actually supporting consumer spending. Yes, it's true we had a bit of a setback in October retail sales, but preliminary evidence we have for November, the first of the 2 months of the holiday shopping season, things were okay, and particularly on the online front. So consumers are spending money. Importantly, what we're going to see unfold in 2016 are things that we haven't really seen before, which is a wealth effect that has been long dormant. But now with home prices across America recovering nearly 80% of the peak-to-trough decline, equity prices just barely off their record highs, I think as 2016 unfolds, we'll begin to see that wealth effect begin to support consumer spending. And, of course, alongside the improvement in consumer spending, we'll get that continued advance in housing. The important thing to keep in mind of housing is tremendous pent-up demand, particularly out of the first-time home buyers or the millennial generation. Compared to that age cohort and other cycles, they aren't buying houses the same frequency as their counterparts would have done 20 or 40 years ago. And obviously we know the reason. They saw what happened to their parents in terms of declines in home prices. They're saddled with a lot more student debt than any other generation has been before. So they're not jumping into home ownership as quickly. But it's not that they're totally against home ownership. It's just happening more slowly. And I think that is the key. Pent-up demand beginning to unfold. Add to the fact that that the household balance sheets are in very strong shape. Banks are actually easing lending standards on the mortgage front. It means mortgage credit creation will be an important supporter of the housing market. And at the end of the day, affordability remains still historically attractive despite the increase we've seen in prices. In fact, I would call sort of the 5% plus, give or take a bit, home price appreciation we're seeing as the sweet spot. In other words, it is above the rate of borrowing costs, which means owning a home is a wealth-generating proposition, always a driver of housing demand, but it's not so fast that you worry about eroding affordability too quickly. So this housing performance can continue for some time, and it's basically going to be those two factors, in our view, are going to be driving growth. What kind of growth are we going to get going forward? We're looking at around 2.5%, give or take a few ticks. Now, right away you're going to say, 2.5% growth, real GDP, that's not that inspiring. Well, keep in mind that headwind I talked about from net exports will be robbing growth, probably to the tune of 0.3 to 0.4 every single quarter on average. So growth is a lot closer to 3% underlying, but we will get that headwind from the net exports, and also to a little more cautious capital spending out of the commodity space, particularly in the oil sector, which is highly capital intensive. Now, the important thing also to keep in mind here is that we're going to get this growth, sort of picking up with underlying potential growth, or the speed limit for the U.S. economy at roughly around 2%. Even growing 2.5%, it's going to continue to take in the slack in the economy, and that's exactly the kind of prospect the Fed wants to see. we believe the unemployment rate will continue to fall. It's already at 5%, which is almost at the bottom of the Fed's longer-term projection of where things will settle down over the next several years of 4.9 to 5.2%. That's not to say we can't dip below 4.9% unemployment rates. In fact, we think we can. But you can't stay there for very long without seeing wage pressures begin to build. And in fact, 2016, in our view, is going to be the year where we think we get that breakout of wage pressures. It's been long in the making, but I think 2016 is when we finally get those pressures going up. Those pressures will help contribute to higher inflation rates, along with, in our view, an eventual stability in commodity prices, particularly oil, and less rapid rate of appreciation of the U.S. dollar. Well, declining unemployment rate, that further improvement in the labor market that the Fed always wants to see, plus rising inflation is exactly what the Fed wants to see in terms of setting monetary policy. Now, ever since March of this year, the Fed has been signaling when we would likely get liftoff, when we get that first rate hike. And they've said, quite frankly, it's when we've seen further improvement in the labor market and we're more confident inflation will return back to 2%. I think the Fed is at that point now. In fact, I thought the Fed was at that point back in July. But as it turns out, the problems we had in September, that tightening up of financial conditions, the worries about the global economy, particularly because of China and other emerging markets, kind of made the Fed a little cautious. But as they said at their October meeting, and as was revealed in the subsequent minutes, most of them said that by December, which as you know is in less than 2 weeks, they'd be raising rates. Interesting, in the speech yesterday, Yellen kind of basically said, in addition to as a vote of confidence in the economy, we're at the point now where we have to think about raising rates, because if we delay it a little too much further, we could literally see pressures begin to build as 2016 unfolds, and will force us maybe to raise rates more quickly, and that may actually cause a risk of a recession. So we don't want to have that to happen. So by going sooner, we get to go more gradually, and going more gradually minimizes the risk of a recession. The other factor too, and this is something that has been many Fed officials have been talking about, rates have been so low for so long that it's creating a lot of excessive, search for yield and risk taking, which of course are threats to financial stability. The important thing here is now in our minds, we have to separate this notion of liftoff, or that first rate hike, versus what happens afterwards. And if there's anything that the Fed has also been signaling, is that rate increases going forward are going to be extremely slow, but they are going to begin. And the reason why they're going to begin is because of the cumulative improvement we've had in the economy generally and in labor markets specifically. This chart, chart number 10, shows the Fed's new labor market conditions index. Came out a few years ago, which they use to gauge how much labor markets are improving and incrementally how much they are tightening. Now, as you know, you just can't look at the labor market or payroll employment, because in all fairness, there's a lot more going on in the labor market than just those metrics. But as you can see here, the steady growth, the steady improvement we've seen in the labor market over this time is given the Fed that confidence that that momentum can continue, and therefore that confidence that inflation will eventually, over the next year or two, move back to the 2% target they've set as a policy goal. Now, labor markets continue to tighten, and of course, we all know, and you faced your own experience yourselves, that the labor markets perhaps aren't as tight as a 5% unemployment rate alone suggests. But importantly, we have begun to see even the broader measures of slack, and that green line on the left panel of chart number 11 shows the U6 rate, which is the underemployment rate. It accounts not only for people out of work, but accounts for people that are working part-time for economic reasons, a measure of slack. It also measures or takes account for the amount of people who have left looking for work, that were unemployed, that are no longer counted in the labor force officially, because they're discouraged and they feel that times are so tough or conditions are so bad that they won't find a job. And so it adjusts for that. But the important thing here is that gap between the broadest measure of slack and the one we follow, the official unemployment rate, has been narrowing at an increasing rate. It narrowed a full percentage point in the past year. In the year before that, it narrowed about 0.7, and the year before that, only 0.1. So labor market slack is being taken in at an increasing rate, and we've started to see now, finally, more meaningfully, the impact on wages. Average hourly earnings did creep up a little bit. The Atlanta Fed's got an interesting metric that has been moving up, but we saw just yesterday with the Fed, with the quarterly figures out of the productivity numbers, that hourly compensation has also gone up, matching its highest level in several years. So wage pressures are going up, and it's a good thing because that also supports this notion that it's going to be a consumer-led recovery, a consumer-led expansion going forward. Now, the big question now, will inflation finally go up? Well, if you just look at core inflation, and whether you look at the CPI version or the price index for personal consumption expenditures, which actually is the Fed's target, they've been within a narrow range over the past little while. The core CPI has been drifting up a little bit, but I always like to break that down between the other major dichotomy in the economy. I mentioned earlier the difference between manufacturing and non-manufacturing. The other dichotomy is the difference between what's happening on the services inflation front and on the goods inflation front. And in fact, looking at core goods, we continue to have deflation in America. That's a result of a stronger U.S. dollar. That's the result of lower input costs into production because of lower commodity prices. But what we are starting to see now is the services part beginning to creep ever so higher. That's not just rents. It's across a broad, in our view, a broad base of services. It's interesting. Whenever my trading desk gives me a hard time for talking up a lot about this idea of services pricing going up, and they're saying, it's just all housing and rent, so it doesn't really matter. I said, well, no, it's not. It's funerals. It's dog grooming. It is massages. It's a whole swath of personal services wherever specialized labor or well-trained labor is required. So, and I'm sure many of you are facing that now, even in your own businesses. The more skill required of your employees in a vacant spot, the more you're having to pay increasingly to get those positions filled. And that's what that leaves us here with my final chart is we do expect, given this dynamic of labor markets tightening now as 2016 unfolds, beginning to put more meaningful upward pressure on wages, which will put upward pressure on headline inflation through the core, and presumably with some stability in commodity prices, particularly oil. We can cover that in the Q&A section later. We will get both headline and core inflation moving back up to the 2% target. We think the Fed will raise rates in a couple weeks, and we'll move on a very gradual pace. We're looking for about a quarter per quarter, in other words, a 25 basis point rate hike every couple of meetings until the Fed, gets to about 1%, and then takes a bit of a pause there until they take a lay of the land and maybe begin to raise rates again. In other words, this rate increase is going to be so slow, it's not going to be worrisome. And that means bond yields don't have to rise as much. And even though inflation is starting to go up, I think the general view of there is the Fed is almost being somewhat preemptive here in terms of raising rates. And that's going to make sure inflation does not, go overshoot or go beyond the target. So both Fed policy and inflation expectations remain well contained. That means that bond yields, while they will go up a little bit, aren't going to rise too much and historically will remain low. Finally, though, as the Fed begins to shift policy while others are still easing, we saw today that ECB began to ease further. Some central banks, will ease again in 2016. We're looking for the People's Bank of China to ease further, the Bank of Japan to ease further. So this asymmetry of the Fed moving stronger and probably only followed by the Bank of England sometime next year, that is going to push up further the U.S. dollar against other currencies, particularly those that are still easing policy, like the yen and like the euro. But hopefully the rate of appreciation is going to slow because, in fact, the appreciation we've seen to this point has largely been in anticipation of the Fed moving in a different direction, following its own path in terms of setting monetary policy. And that's exactly what we're going to see as the year unfolds. So that's it for me. I think I've reached my allocation of time. So I'll perhaps pass things over to my colleague, Chris Kuehl, to take us on the next step of this webinar. Thanks.
Thank you, Michael. This is Jim Warren of FMA, and I'll be doing an introduction of Dr. Kuehl. Thank you very much, Michael. That's excellent. With no further ado, Dr. Chris Kuehl serves as the Economic Analyst for the Fabricators and Manufacturers Association International. One of the major roles Chris has for us is writing an economic e-newsletter twice a month called Sabernomics, specifically designed to aid business decision-making by management and job shop owners in the metal forming and fabricating industry. And Chris also conducts workshops for FMA, speaks at our major conferences and our trade shows. Chris is the managing director of Armada Corporate Intelligence. Armada's mission is to combine the traditions of corporate and competitive intelligence with strategical and tactical planning to provide clients with a clear view of the world they exist in and what they can do to advance their goals. Major clients are YRC Freight, Trans Systems, Kansas City Southern Railroad, CBiz, and many others. Chris holds a PhD in political economics. He holds a master's in East Asian Studies and a master's in Soviet and East European Studies. Also was a professor of international economics and finance for 15 years prior to founding Armada CI in 1999. He's taught in the U.S., Hungary, Russia, Estonia, Singapore, Canada, and Taiwan. Chris, it's all over to you, sir. Thank you.
All right. Thank you very much. Well, as you can see by the first slide, it's important for economists to kind of find a way to put ourselves in perspective. We are forever grateful for the existence of meteorologists. They tend to make us look good. So the last year or so has been kind of an adventuresome one for economists because a lot of the things that we assumed were going to happen either didn't happen or didn't happen quite as we anticipated they were. I think this is going to be an interesting conversation. I know Jim in the past has always been wanting to find dueling economists, people who will disagree and create some kind of great interaction and tension. Unfortunately, both of us are kind of on the same page as far as where the economy is going to be in the coming year. So I do not have any howls of outrage to present as regards Michael's presentation because I think he's really hitting it on the head. We're getting into a period where a lot of what we thought was going to happen this year is likely to be happening in 2016, unless, of course, we're wrong again. So we'll just see how that proceeds. I'm going to talk a little bit more about the issues that are of greatest importance, I think, to the manufacturing sector, kind of representing the FMA's concern, but I'll wander off into other areas as appropriate. And when we get to the question and answer stage, people can ask whatever they want. One of the comments that Michael made, which I think is very germane, is what's happening with jobs. And it's one of the things that really undergirds pretty much everything that's going to be happening as far as the consumer interaction with the economy. The consumer really is two people. On one side, they're a consumer. On the other side, they're a worker. And if they don't have a job, and if they're not being paid very well, they're not going to be much of a consumer. One of the concerns we've had for the last couple of years has been that many of the new jobs that are coming in are not particularly well paid. They're often in the service sector. They are not as robust as the jobs that we might have had 10, 20 years ago. Manufacturing used to be kind of the sector that contributed the emerging kind of lower to middle class. These were people who were going to get good, decent jobs, hang on to them for 20, 30, 40 years. And that pattern has shifted. And now the new jobs tend to be in retail, they tend to be in healthcare, they tend to be in a whole series of other services, some of them well paid, but a lot of them not. This chart shows where the expectation of working class employment is going to be in the next year to 5 years. And it's really kind of interesting because you can kind of pick out where you've got a certain sector driving jobs. If you look at the Dakotas and Colorado, those dark blue circles and lines, those are energy related. And that's something that may start to tail off. As the energy sector continues to deal with low oil prices, you're not going to see the hiring that you saw the last 4 or 5 years. But interestingly enough, at least so far, there has not been a whole lot of sort of skilled labor dismissals. Companies work very hard to get people to come up into those areas, and they're reluctant to let them go. A lot of the growth that you see in the Southeast is manufacturing. And I'll show you a chart in a minute that shows kind of the shift in the emphasis of manufacturing, where it's taking place in the U.S., where it's growing. If you look in the Southwest, particularly Arizona into California, a lot of that is healthcare related. These are not manufacturing jobs. They're not energy sector jobs. They're jobs that are revolving around an aging population. The baby boomer continues to have a tremendous impact on the economy as they move through their various stages of life. And right now, their stage of life is early retirement and getting into their retiring years. There seems to be a drive for the baby boomer to live in some combination of Club Med and ER. So they're moving into assisted living. They need more attention. They need more help. Gerontology is the hot field in medicine, blah, blah, blah. So you're seeing a lot of these working class jobs hugging where the retirement sector is going to be. The other thing to take from this chart or this map is that you've seen a lot of drift out of the traditional manufacturing states, the Michigans and the Indianas and the Ohio's. They still see a lot of growth compared to some parts of the country, but these used to be the manufacturing heavy states, and they're losing some of that that concentration to states in the South. If you look at the next map, this is an indication of what states depend on manufacturing, as in the dependence is a little bit of a loose interpretation, but it means that something close to half of their state GDP is related to manufacturing. Some of these states makes perfect sense. It's been that way forever. Michigan, Wisconsin, it's just the industrial Midwest. But what's unusual or new is that you're starting to see a lot more concentration again in the South. So you have states like Arkansas and Mississippi and Alabama is dependent on manufacturing. It does not mean that these now have more manufacturers, though that's beginning to be the case, and it doesn't mean that they have more manufacturing employees. It just means that their economies are changing. Their economies used to be agricultural, very service-oriented, and now the growth is in manufacturing jobs. To the west, you don't see a lot of dependence. This is where the mining sector, agriculture, ranching, et cetera, dominate. But the middle of the country is where this manufacturing surge is taking place, and a lot of this is being driven by overseas activity. You're seeing a lot of investment in the U.S. from Europe, from Asia, from the Middle East, even from Latin America, and much of that is ending up in some of the southern states. I do a lot of work with rural economic developers, and for the last several years, it's been really interesting. I'll go to a meeting of people who literally represent the most rural areas in Tennessee and Kentucky, and I'll ask, how many of you have been approached by a Chinese business or a Chinese official looking to invest? Every single hand goes up. Every single person will say, oh, yeah, they're here constantly looking to invest into our community.
Really cold here, so
because that's where the opportunities are as far as China is concerned. And they see this as a way to be involved in the U.S. economy, to be involved in the distribution and marketing channels. You see that same pattern coming from other countries. China is still a very distant fourth when it comes to investing in the U.S. The number one investors in the U.S. are still the United Kingdom, Canada, Germany comes in third, and China. And in terms of expansion speed, China is number one. They're more aggressively investing now than was the case even 3 or 4 years ago.
Hey,
you bet. Otherwise, we're going to find out way more about it. So, all right. The next slide is really just an indication of a bit of myth busting that I think is important as we look at the economy going forward. I agree completely with Michael that this is going to be a consumer-driven recovery. They almost always are. I mean, consumer activity is 70-80% of the U.S. economy, depending on how you measure it. But the nice thing about consuming is that somebody has to make the stuff that you consume. And one of the challenges over the last several years is to figure out who's going to make it, where it's going to come from, what is the economic driver behind this. And one of the assumptions that seemed to be made was that the U.S. was no longer going to be a manufacturing nation, that we were evolving into some sort of post-industrial world where, we just manufacturing part of the U.S. GDP out, that's the little yellow box. This is kind of an eye chart and hard to read. But the only thing to really get out of this is that every one of those green lines are countries. The yellow line is just the manufacturing segment of the U.S. economy. That alone is bigger than the entire GDP of India. So we are still a manufacturing state, and increasingly we're getting back some of that manufacturing mojo, and for some of the reasons that Michael alluded to. One of the major changes, I think, as far as manufacturing is that we have shifted from being a very kind of labor-intensive type of industry to one that is far more oriented towards machinery, technology. It's the sort of thing that allows us to be competitive with countries that have low production costs, low wages. The U.S. will continue to advance in that direction. One of the things that may begin to affect that progress is that as we start to see interest rates go up, the cost of borrowing will begin to go up. It's not, we're looking at a kind of a growth of, I guess I would refer to it as the robotization of manufacturing. It allows us to compete, but it also means that we need to buy stuff to do that. We need to do capital investment. And the capital investment is determined to some degree by the interest rates that we'll be looking at. Like I said, it's not going to be a big factor next year, even if rates start to go up in December, and I agree with Michael, they probably will. The rate increase is incremental. It's probably going to be incremental through most of next year. And in the meantime, companies that have been putting off doing some of that capital investing may start to do it in order to beat higher rates anticipated later. This slide, the next one, I think this is slide number 5 with mine, is kind of the story of manufacturing in the U.S. in a slide. We've seen consistent growth in productivity since the 50s. We have seen an absolute drop in employment, and again, related to the changes in manufacturing. Michael was alluding to some of the shifts in terms of wages and productivity. The data that just came out today indicated that we're starting to see wage growth, we're starting to see productivity growth, not spectacular at this point, but 3 to 3.5% better than a year ago today. So it's definitely trending in the right direction. I agree with Michael completely that one of the headwinds has been that wages have not gone up. But one of the challenges when you're looking at wages is that you really have to look at both inflation and wages. And because inflation hasn't gone up, stagnant wages have not been as problematic as they might have been. If we were dealing with high inflation and stagnant wages, you'd be in a real hurt. People would not be making enough money to keep up. As it stands, things are just stagnant. There's not been much inflation, and there hasn't been much wage growth. When you start to get inflation is generally when wages start to go up because the pressures become greater. I mean, right now, an individual who's been sitting at roughly the same wage for the last few years is sort of like, well, you know, I'd sure like to get a wage increase, but hey, gas prices are down and the food prices came down, and I haven't really seen anything go up specifically, at least if they're not dealing with education and healthcare. So they're more or less content. The day of contentment stops abruptly when all of a sudden prices are going up and wages aren't. And then all of a sudden people are like, wow, I cannot afford to do what I did last month on what I'm being paid. And all of a sudden the pressure becomes enormous and companies have to start reacting. They either have to start paying people more or finding some other way to react to these changes. The next slide indicates where the growth is in the U.S. No big surprise. It tends to be on the western side. You're not seeing as much in the industrial Midwest, definitely some slow growth in New England. Much of this, of course, is related to specific activity in those states and regions. The West has been very dependent on energy, and some of that growth that we see now is likely to start fading because we're not seeing the growth triggered by gas and oil development. States like California and Texas, much more diverse economies. Probably Texas will not feel the impact of the energy sector decline, not nearly to the point that, say, North Dakota or Montana will. The middle of the country is where a lot of attention is focused, obviously a lot of population there, and a more diverse economic situation. So people are going to be watching carefully to see what happens. The next slide is one of my favorites because it's one of those things that just helps you understand just how big this country is and how difficult it can be to sort of get a read on what's happening from year to year. These are state GDPs compared to national GDPs. And, this data is about a year or so old, so some of this relationship has changed, but not by much. Canada is still the size of Texas. The city of Dallas has the same GDP as Argentina. The city of Chicago has the same GDP as Switzerland. My personal favorite here is Norway and Minnesota. You couldn't have done that if you tried. But the point is, these are all literally mini countries. And talking about growth in the U.S. means literally looking at all 50 states and understanding that you may have growth in one part of the country, one state. You won't have growth in another. And it kind of creates a challenge to sort of categorize these enough to know what direction. Every time I give talks on the economy, there will always be somebody who will come and say, I'm not seeing any problems at all. We've had more business this year than we've ever had. We're making money hand over fist. My whole state is rich. My whole city is rich. You have no idea what you're talking about. And then right behind them is someone saying, oh, my God, every business in town is falling apart. The state is losing money. I've fired everybody. I'm losing my entire career. And they're both right. I mean, it just depends on the industry that you're in. The last few years when I would give talks in the Dakotas, I mean, if I even mentioned the word recession, they would just start laughing and couldn't stop. I used to call the Motel 6 in Williston to see how things were going up there. And at one point, it was $450 a night to stay in a Motel 6. That is no longer the case. Now, when I go to North Dakota, it's like, oh, my God, what's happened to our economy? Are we ever going to come back? So things change, and they change rather rapidly. The next slide, again, something that Michael was talking about, the labor situation. We measure unemployment in lots of different ways. He pointed out the difference between U3 and U6. One of the challenges that we're dealing with in the manufacturing sector in particular is where do you find the people to fill the jobs we have available? The skill gap is still large and getting larger. We have around 10,000 people a day retiring in the U.S. just because they reached 65 or an age where they can, and that's taking a significant amount of that skilled labor out of the workforce. We have low workforce participation, in part because we're dealing with a lot of people retiring. There's lots of reasons that people leave the workforce. In some cases, it's involuntary. They're looking for jobs, can't find them. But in many cases, they're leaving it for perfectly legitimate reasons. They've reached retirement age, or they're close enough, and they can leave. You have families where spouses make the decision that it's simply not economically useful for one of them to be in the workforce and be paying for childcare. That it's cheaper to take care of their own children and wait till they're old enough and then re-enter the workforce. We have a lot of labor shortage issues, and it's not an easy problem to solve. It's been a headwind for a while. Companies indicate that they would be expanding, that they would be taking on more work if they had the people that can actually do the job. And it's a slow solution. It means getting education institutions on board. It means convincing kids that manufacturing is a career. It means getting to high school counselors and teachers. Those of you who are familiar with FMA's work, and particularly the Nuts, Bolts, and Thingamajigs Foundation, you know that that's what they're devoted to, is trying to get people to understand how the labor market plays into the growth of manufacturing. And this is kind of a repeat of what Michael had earlier with the difference between U6 and U3. There are 6 different cuts of the data that comes out from Bureau of Labor Statistics, all of these cuts trying to get to a certain aspect market. And the important thing is, and people will say this all the time, U3 is 5%, but look, U6 is almost 10. The issue is that there's always a gap between them, but it's important that they're narrowing, and it's also important that both U6 and U3 have been declining. The last few slides this is an index that I worked on for the National Association for Credit Management. If you're familiar with the PMI, and Michael mentioned this, the PMI data fell into the 40s, into the contraction zone in this last month, and that's not necessarily good news. It basically means that on the manufacturing side, there has been a slip. The service numbers weren't much better. Not catastrophic. It's not an exact science. It's not where if you fall beneath 50, the world comes to an end. It just means that your trend is not where you'd like it to be. The Credit Managers Index is based on the same principles as the PMI. It is looking at the world through the same diffusion index, the same structure, only instead of asking purchasing managers what's going on, we're asking the credit manager what's going on. The credit manager is being asked questions about number of applications for credit, dollar collections, accounts out for collection, bankruptcies, disputes, slow pays, accounts beyond terms, all these different things to keep credit managers awake at night. What we have seen in past years is that the CMI will tend to, in a sense, advance alert as to what's happening with the PMI and the economy as a whole, because credit managers are going to be involved in decisions really, really early. The interesting breakdown of this data is that the good news stuff has been consistently good. We're still seeing a lot of sales growth. We're still seeing a lot of applications for credit, companies expecting to buy machinery, do capital investment. The dollar collections have been solid. We call these the favorable factors, and they have all been favorable. A couple of them are still in the 60s. The issue is with what we call the unfavorable factors. And these are the ones like accounts out for collection, disputes, bankruptcies, slow pays. It signals that these are companies, at least some in an average credit manager's portfolio, are struggling. They are not able to pay on their credit as they were. They're falling behind. It's gotten to the point that now collection agencies have gotten engaged. So it's a distressing trend, but again, it's not at this point a panic point. Most of the numbers are in the high 40s, 48-something, 49-something. They're not that far off normal. And some of the critical ones, like bankruptcies, are still in the 50s. They're still relatively low. So we're going to be watching kind of as the CMI rolls out. The last few months, as you can tell by the amount of red, has not been particularly exciting. On the manufacturing side, pretty much the same pattern with not quite the same intensity. And then you get to the service side, and everything was looking sort of okay until we got to this last month. A lot of the distress was being caused on the service side, particularly in retail. And it's basically because retailers put an awful lot of emphasis on this part of the year, and it hasn't quite turned out as they had expected. It's not bad. We're going to do better, I think, than last year, but not as much better as people had anticipated. And companies ran some risks. If you look at the inventory levels right now, they're relatively high. And this was an anticipation, I think, of a better retail year than we're actually getting, and it's making people just a tad nervous. So with that, I'm going to leave time for questions, and Michael and I can try to come up with some, legitimately believable answers to what you asked. And if not, we'll just simply say, gee, that was an interesting question, and move on.
Great. Thank you very much, Dr. Kuehl.